Hello and welcome to this episode of my tutorial video series. The subject of this video is cost and management accounting, and in this video I shall discuss the difference between marginal costing and absorption costing. Marginal costing and absorption costing both are systems of costing, because by applying these systems or these methods, we can determine the cost of production, cost of product per unit, and we can make valuation of the inventory. That is the reason these are called systems of costing. In addition to it, marginal costing is also considered as a technique of costing, because marginal costing provides many valuable management accounting tools for decision making. Okay. Now, the two main points of difference between marginal costing and absorption costing are: number one, cost of product, and number two, valuation of stock. In marginal costing, only the variable costs are charged to the product. That is, the direct material cost, direct labor cost, and direct expense, if any, and the variable factory overhead are included in the cost of production. All other fixed overheads, including fixed manufacturing overhead, fixed administrative overhead, and fixed selling and distribution overhead, are treated as period cost and are charged to the income statement or profit and loss account. On the other hand, absorption costing is a method of costing, because by applying absorption costing, we can find out the cost of production, cost of product per unit, and we can value the stocks. Unlike marginal costing, in absorption costing, the prime cost, that is the direct material cost, direct wages, and direct expense, if any, plus the variable factory overhead, plus the fixed factory overhead are charged to the cost of production as well as for valuation of inventory. This is the reason the cost of production as per marginal costing system differs from cost of production as per absorption costing system. At the same time, valuation of stock as per marginal costing system differs from the valuation of stock under absorption costing system. Right? Now, we shall take a numerical example to see how these two systems work out. Right? So, we are taking this example. A farm is producing a product, and the cost structure is direct material cost per unit is $50, direct wages per unit is $40, the variable factory overhead is $30 per unit, selling price $400 per unit, and fixed overhead is 100,000 per annum. Capacity, that is 100% capacity, that is installed capacity, is 2000 units, but the farm the farm is manufacturing 2000 units and selling 2000 units. This is one scenario where actual output is equal to the maximum output possible, that is, the farm is fully utilizing the installed capacity. Capacity is 2000 units, and the farm is producing 2000 units, and the farm is selling 2000 units. So there is no closing stock. And this is scenario 2, That is, actual output is 1800 units and sales is 1500 units. And these are the data at the end of year 1. That means there is no opening stock. In scenario 1, there is no closing stock. And in scenario 2, you can see that actual output is 1800 units, which differs from the installed capacity, and sales is 1500 units. This means there are 300 units of closing stock. Correct? So first we shall find out what is the cost of production per unit under marginal costing and absorption costing. Okay. So here we are calculating cost of production per unit. First we are doing marginal costing. Direct material cost, I am writing DM in short for direct material cost. DM $50. Let me do one thing. Let me work out marginal and absorption costing side by side so that I can save some space. I am writing MC for marginal costing and AC for absorption costing. Correct? So direct material is, currency is dollar. Direct material 50, here also 50. Direct wages DW 40, here also 40. Variable factory overhead, FOHD means factory overhead, V means variable. Variable factory overhead $30. Sorry, $30. Correct? And fixed factory overhead. Here is no fixed factory overhead. As I said few minutes back, that fixed overheads are not considered in calculating cost of production. So there is no fixed overhead in the cost of product per unit under marginal costing system. And what will be the fixed overhead in absorption costing? This is, what is the total overhead? Total fixed overhead 100,000, and what is the capacity? 2000 units. Okay, so 100,000 divided by 2000, so it comes to 50. This is cost of production per unit. Under marginal costing it is 50 plus 40, 90 plus 30, $120, and here 120 plus 50, that is 170. Okay. Yeah. Direct material cost 50-50, direct wages 40-40, variable factory overhead 30-30, and under marginal costing there is no fixed overhead in cost of production, but in absorption costing there is fixed overhead in the cost of production. And what is that? That is fixed overhead, that is 100,000 divided by the capacity. This is the fixed overhead per unit. So cost of production per unit is $120 under marginal costing and $170 under absorption costing. Correct? Now we shall see what is the profit under marginal costing and absorption costing under scenario 1. That is, actual output is equal to sales, and that is also equal to the total capacity. There is no closing stock, and since the data are at the end of year 1, this means there is no opening stock. So here scenario 1, no closing stock. Scenario 1, no closing stock. Sales what is the number of units sold in scenario 1? 2000 units. So sales is 2000 into what is the price per unit? 400. So 2000 into 400, that comes to 800,000. Okay, less under marginal costing. What we do? We deduct the variable cost from sales. So less variable cost of goods sold, or variable COGS, VCOGS, variable cost of goods sold. What is that? Opening stock plus cost of production minus closing stock. So we don't have any opening stock. What is the cost of production under marginal costing? 120 into number of units produced, that is the cost of production. What is the number of units produced? 2000. So 2000 into 120, this comes to 2,40,000. And this is 0. So this is 2,40,000. Correct? Now sales less variable cost of goods sold, that is VCOGS. This gives us contribution. So 800,000 minus 240,000. So it comes to 560,000. Okay. Do not put double line. Now, what is the marginal costing formula? Sales minus variable cost is contribution, and contribution minus fixed cost is profit. So we have to deduct fixed cost at this stage, less fixed overhead. How much is the fixed overhead? 100,000. Okay, so this is profit before tax or PBT. Okay. We have calculated profit before tax, that is PBT, under marginal costing system in scenario 1, that is there is no closing stock. No closing stock. Sales is 2000 into 400. 400 is the sales price per unit. It comes to 800,000 less variable cost of goods sold, VOCGS, that is opening stock plus cost of production minus closing stock. We don't have any opening stock or closing stock. We don't have any opening stock or closing stock. So the cost of production itself becomes the variable cost of goods sold, that is 240,000. We have deducted the variable cost of goods sold from sales, and that has given us what? That has given us contribution 560,000. From contribution we deduct fixed overhead to arrive at profit. So at this stage we have deducted fixed overhead, and what is the fixed overhead? 100,000. So 560,000 minus 100,000 gives us 460,000. Now let us see what is the profit under absorption costing. Sales remains same, that is 2000 into 400, that is 800,000 less. Here we are not writing variable cost of goods sold. We shall write only cost of goods sold. Cost of goods sold. It is COGS. Okay. Again, opening stock. We don't have any opening stock. Plus cost of production. What is the cost of production? Cost of production per unit is 170, and number of units produced is 2000. So cost of production is 2000 into 170. Okay. 170 into 2000. This is the cost of production. So this comes to 170 into 2000. This gives 340,000. So 340,000. there is no question of contribution and again deducting fixed overhead, because fixed overhead has already been taken into account here in cost per unit, and we don't find out contribution in absorption costing system. So sales minus cost of goods sold gives us what? Gives us profit before tax, that is PBT. How much? 800,000 minus 340,000, so it comes to 460,000. Okay. Sales is 2000 into 400 per unit sales price, it is 800,000 less cost of goods sold. Remember, not variable cost of goods sold, because we are considering fixed cost in cost of goods sold. So cost of goods sold, again opening stock plus cost of production less closing stock, less closing stock. So we don't have any opening stock. And what is cost of production? 170 into 2000, that gives us 340,000. So sales minus cost of production gives us profit before tax, PBT, that is 460,000. Now you see, profit under marginal costing is same as profit under absorption costing. Why this has happened? This has happened because there is no opening or closing stock. If there is no opening and closing stock, then the profit as per marginal costing will be exactly equal to the profit under absorption costing. Profit will differ if there is closing stock and opening stock. Okay. Now here we shall do the scenario 2. Correct? Scenario 2. What is the scenario 2? Okay, there is no opening stock because this is the first year of operation of the firm. What are the difference between scenario 1 and scenario 2? In scenario 1, actual output is 2000, and in scenario 2, actual output is 1800. And the sales in scenario 1 is 2000 units, that is, there is no closing stock. And in scenario 2, sales is 1500 units, that means there is closing stock of 300 units. So here we write closing stock 300 units. This is scenario 2, closing stock 300 units. Okay. We shall follow the same format as we have done right now, that is sales how many units? 1500 units. So 1500 into 400. So 1500 into 400 gives us how much? 415, 60. 600,000. Okay. Less variable cost of goods sold, VCOGS, variable cost of goods sold. Here opening stock, nothing, plus cost of production. What is the cost of production in scenario 2? Under marginal costing, 120 is the cost of production per unit, and what is the number of units? 1800 units. So cost of production is 1800 into 120. Number of units produced multiplied by cost of production per unit. So 1800 into 120. So we get 216,000. So this is 216,000. Correct? Minus, sorry, write it here, 216,000. Minus what? Minus closing stock of what? Of finished goods. Closing stock of finished goods. What is the number of closing stock? 300. So this is 300 into cost of production per unit, 120. So 300 into 120, and we get 36,000. Correct? So 216,000 minus 36,000. We get 180,000. Okay, sales is 1,500 into 400, that is 600,000, less variable cost of goods sold, that is opening stock plus cost of production minus closing stock of finished goods. So there is no opening stock. What is cost of production? 1,800 units produced into 120, we get 216,000 less closing stock. What is the closing stock? Actual production minus sales, that is 300 units. So 300 into 120, that gives us 36,000. So opening stock plus cost of production minus closing stock is 180,000. So we get here what? Contribution how much? 4,20,000. Okay. From contribution, we shall deduct what? We shall deduct fixed overhead. So less fixed overhead, how much? 1 lakh per annum. So minus 100,000. Now we get what? Now we get profit before tax, that is PBT. 420,000 minus 100,000, it comes to 320,000. Okay. So scenario 2 under marginal costing, where we have 300 units of closing stock, actual output is 1,800 units and sales 1,500 units. So we have 300 units of closing stock, and also here the actual output has differed from the installed capacity, because installed capacity is 2,000 units. So from sales we deduct variable cost of goods sold. Sales is 1,500, that is number of units sold, multiplied by selling price per unit, we get 600,000. We deduct variable cost of goods sold. We find variable cost of goods sold by this way, that is opening stock plus cost of production less closing stock of finished goods. There is no opening stock, and cost of production is how much? 1,800 units produced multiplied by cost of production per unit 120. So 1,800 120 into 120, we get 216,000 less closing stock 300 units. 300 units into cost of production per unit 120 under marginal costing. So 300 into 120, we get 36,000. So 216,000 minus 36,000, we get 180,000. So sales minus variable cost of goods sold gives us contribution of 420,000. From contribution we deduct fixed overhead of 100,000. So 420,000 minus 100,000, we get profit before tax of 320,000. So scenario 2 under marginal costing is done. Now we move to scenario 2 under absorption costing. Same format, sales, same 1500 into 400, 1500 into 400 gives us 600,000 less cost of goods sold, not variable cost of goods sold, as we have done under marginal costing. Here it will be less cost of goods sold. Same format once again. Opening stock we don't have any, plus cost of production. Now what is the cost of production? 170 into 1800. So 170 into 1800. 170 is cost per unit, and 1,800 units have been produced. So 170 into 1800. 170 into 1800. This gives us 306,000. 306,000 0, 0, 0. From here we deduct what? Closing stock. How many units? 300 units. So closing stock is 300 into what should be the value? Per unit is 170. So 300 into 170. So this gives us 51,000. Correct. Sales is 1500 into 400. 1500 into 400. 600,000 less cost of goods sold. Under cost of goods sold we have opening stock 0 plus cost of production, that is 170 into 1800, number of units produced, into cost per unit. Okay. So we deduct 306,000 minus 51 minus 51,000. We get 255,000. Right? Closing stock is 300 units into 170. Correct? So we get how much? 600,000 minus 250, that is we get 600,000 minus 255,000 345,000. Now be very careful. This is not our profit before tax. Why? You see, fixed overhead is 100,000. And remember, fixed overheads are fixed according to the installed capacity. Correct? So fixed overhead is being recovered at the rate of rupees 50 per unit. That is, if the firm produces 2000 units, then 50 into 2000 becomes 100,000. That means the fixed overhead is fully recovered or fully absorbed. But if the firm produces less than installed capacity, what here the firm is doing, the firm is producing 1800 units. That means the firm is not producing 200 units, that is, the firm is not able to absorb the full overhead. This is called under absorption. This is called under absorption. the firm is not able to fully absorb the fixed overhead. Here, when the actual output was equal to the capacity, full capacity output, then the firm was able to recover the full overhead by applying this rate 50. 50 is the rate, because 50 into 2000 becomes 100,000. But since in scenario 2 the firm is not producing full capacity, the firm is producing 200 units less, that means the firm is unable to recover the full fixed overhead. This is called under absorption. That under absorption has to be deducted from here. And what is the value of under absorption? We write here minus under absorbed fixed overhead. This is very important. This is very important, and please carefully watch this part. How much unit the firm could not produce? 200 units. And what is the fixed overhead rate? 50. So the amount of under absorption is 200 into 50. So 200 into 50 means 10,000. This is under absorbed overhead. Right? Now we get PBT, profit before tax. This is 345 minus 10,000, that is 335,000. Correct? So you see here, that is in scenario 2, profit before tax under marginal costing is not same as profit before tax under absorption costing. Under absorption costing it is 335,000 and under marginal costing it is 320,000. Whereas in scenario 1 there was no difference in profits as per marginal costing and as per absorption costing. Why this happened? Because in scenario 1 there was no closing stock. Of course there is no opening stock because this is the first year of operation of the firm, and in scenario 1 we considered there is no closing stock. And since there is no closing stock, there is no difference in profits under two systems. But in scenario 2 we have considered closing stock. Actual output differs from sales. Sales is less than actual output by 200 units. Correct? Due to this, profits have differed. Under absorption costing it is 335,000 and under marginal costing it is 320,000. Now we shall cross check or we shall reconcile these two profits as we have done in financial accounting. The bank reconciliation statement BRS, where we reconcile the balance as per the bank statement with the balance as per the cash book of the firm. Similarly, in case of profits under marginal costing and absorption costing, we can reconcile these two profits. Okay, so we are reconciling here. Reconciliation of profits under marginal costing. MC is marginal costing and AC is absorption costing. Profit as per absorption costing. Start by profit as per absorption costing. What is the profit as per absorption costing? 335,000. Correct? 335,000 is the profit as per absorption costing. Now from here we shall deduct the difference in the values of closing stocks. Here closing stock is 36,000 and here closing stock is 51,000. So we shall simply deduct this difference from profit as per absorption costing and we will reach profit as per marginal costing. So less difference in closing stock, that is 51,000 under absorption costing and 36,000 under marginal costing. So difference will be 51,000 minus 36,000. 51,000 minus 36,000. How much? 51 minus 36 is 15,000. Okay. So we deduct 15,000 from 335,000 and we get how much? Okay. This is profit as per marginal cost. Tell it. So we have done right. Our working out of the problem, the solution is correct. This is also a way of cross-checking. Reconciliation enables us to cross-check whether we have done it correct or not. So, what we have learned in this video? We have learned that marginal costing and absorption costing both are methods of costing because both methods are used in finding out cost of production, cost per unit, and to value the closing stock. In addition to that, marginal costing is also a technique of costing because marginal costing provides us many useful tools. For example, break-even analysis, CVP analysis, etc. for making decisions. There are many decision making situations like make or buy, whether to participate in a competitive market by lowering the price, whether an export order should be accepted, how to plan the profit, how to price the product. Okay. So these are the decisions management can take by applying tools of marginal costing. So marginal costing is a system of costing as well as a technique of costing, whereas absorption costing is a system of costing. By applying absorption costing, we can find out the cost of product and the value of frozen stocks. It can be work in progress or it can be finished goods. Now we have taken one numerical example where this is the direct material, direct wages and variable factory overhead cost per unit. Fixed overhead is given 100,000 per annum. Selling price is for $400 per unit. The installed capacity is 2000 units. 100% capacity is 2000 units. Now we have taken two scenarios. In scenario 1, actual output is equal to the installed capacity and sales is equal to the actual output. That means there is no closing stock. And since this is the firm's first year of operation, so there is also no opening stock. And we have considered scenario 2 where actual output is less than the capacity, full capacity, and actual sales is also less than actual output, so there is closing stock. In scenario 1 there is no closing stock. In scenario 2 there is closing stock of 300 units. In scenario 1 there is no opening stock. In scenario 2 there is no opening stock. In this part we have calculated cost of production per unit under marginal costing and under absorption costing. MC means marginal costing, AC means absorption costing. Under marginal costing we have taken direct material cost, direct wages and variable factory overhead. We have not taken fixed factory overhead. We have taken only variable factory overhead. And in AC, that is absorption costing, we have taken direct material, direct wages, variable factory overhead as well as fixed factory overhead, which is 100,000 per annum divided by capacity output. That is 100% production, 2000 units. Okay, that is 50. So cost of production per unit under MC is 120 and under AC is 170. Now in this section we have worked out the profit under two scenarios and under two systems, that is marginal costing and absorption costing. First scenario, marginal costing, scenario 1, no closing stock. Sales 200 into 400, 2000 into 400. Sales, number of units sold into sales price per unit, that gives us 800,000 less variable cost of goods sold. Remember, in marginal costing we will deduct variable cost of goods sold from sales, and that we find out in this way, that is opening stock plus cost of production less closing stock. There is no opening stock, zero opening stock. Cost of production is how much? 120 into output 2000, that gives us 240,000 minus closing stock, there is no closing stock, so variable cost of goods sold comes to 240,000. We deduct this from sales and we get contribution. It is also called contribution margin, same thing. So 800,000 minus 240,000 equals to 560,000. So contribution is 560,000. And in marginal costing system, we deduct fixed overhead from contribution to arrive at profit. So from contribution of 560,000, we deduct fixed overhead of 100,000. So 560 minus 100,000 equals to 460,000. This is profit before tax under marginal costing, where there is no closing stock. And scenario 1 in absorption costing, in this section, sales remains same, less cost of goods sold, not variable cost of goods sold. Remember, in case of absorption costing, it is cost of goods sold because we are considering fixed overhead as well. So less cost of goods sold, again the same format, opening stock plus cost of production less closing stock. No opening stock, 0. And what is cost of production? 170 into 2000, actual output 2000, that gives us 340,000. So we straight away deduct it from sales, that is 800,000 minus 340,000, we get 460,000. This is profit before tax. So we see PBT under marginal costing and absorption costing are same, 460,000 in both the cases. Why? Because there is no closing stock. If there is no closing stock and if there is no opening stock, then profits under both the system will be same. Now come to scenario 2. In scenario 2, output is 1800 units, which is less than capacity output, 100 capacity output, and also sales is less than actual output, so there is closing stock of 300 units. 300 units is the closing stock, both the cases, in both the systems. So again, we follow the same format as we have done in scenario 1, that is sales 1500, the sales amount, sales figure multiplied by sales price per unit. So 1500 into 400, that gives us 600,000 less variable cost of goods sold as we have done in scenario 1, VCOGS, and we follow the same format, opening stock plus cost of production less closing stock of finished goods. There is no opening stock. And what is cost of production? How many units produced? 1800 in scenario 2. The 1800 into 120 cost of production per unit. So we get 216,000 less closing stock of finished goods. How many units are left? 300. So 300 is the closing stock, and 300 into 120 cost of production per unit. So the value of closing stock is 36,000. We deduct this from 216,000, we get 180,000. So this is 180,000 is the variable cost of goods sold. We deduct variable cost of goods sold from sales and we get contribution 600,000 minus 180,000 equals to 420,000. This is contribution. From contribution we deduct fixed overhead as we do in marginal costing. So contribution minus fixed overhead of 100,000, we get PBT, profit before tax, and PBT, you can also call it net profit, same thing. This is net profit, same thing. So PBT is 320,000. Now come to scenario 2 under absorption costing system. Sales remains same, less cost of goods sold, not variable cost of goods sold, only cost of goods sold in case of absorption costing system. We follow the same format as we have done in scenario 1, that is opening stock plus cost of production less closing stock. There is no opening stock. And what is the cost of production? 170 into number of units produced, that is 1800. So 170 into 1800 gives us 306,000 less closing stock. 300 units into cost per unit 170. So 300 into 170, we get 51,000. So the cost of goods sold becomes 255,000. We deduct 255,000, that is cost of goods sold from sales, and we get 345,000. But this is not profit before tax or net profit. Why? Because the farm has not produced the full capacity output. If the actual output is less than full capacity output, that means there is under absorption of overhead. Overhead could have been fully absorbed had the farm produced full 2000 units, because fixed overhead is fixed on the basis of capacity output, 100% capacity output. But the farm has failed to produce 2000 units and it has actually produced 1800 units, that is 200 units less than 100% capacity. So from here we shall deduct under absorbed fixed overhead, that is 200, that is 100% capacity production minus actual output, 2000 minus 1800, that is 200 into 50. What is 50? 50 is the overhead, fixed overhead absorption rate, 100,000 by 2000. So this gives us 10,000. We deduct 10,000 from 345,000 and we get PBT, that is profit before tax or net profit, same thing, or net profit, that is 335,000. So we see, as there is closing stock in scenario 2, profit under absorption costing differs from profit under marginal costing. Profit under absorption costing is 335,000 and profit under marginal costing is 320,000 because of closing stock and valuation of closing stock. Now in this section we have reconciled these two profits as we do in case of bank reconciliation statement in financial accounting, where we reconcile the balance as per bank statement with the balance as per the cash book of the firm. So here we start from profit as per absorption costing, that is 335,000, and from there, remember, from profit as per absorption costing we deduct difference in closing stock. And what is the difference in closing stock? Closing stock as per absorption costing is 51,000 and closing stock as per marginal costing is 36,000. So the difference is 51,000 minus 36,000. 51,000 minus 36,000, that gives us 15,000. So we deduct this difference from profit as per absorption costing, that is 335,000 minus 15,000, and we get exactly the profit as per marginal costing, 320,000. Correct? So this is all about application of marginal costing system and absorption costing system and differences between marginal costing and absorption costing. We have taken our numerical example to understand how these two systems work, how they influence the cost of production, cost per unit and valuation of closing stock, and ultimately how they influence the net profits. And here we have reconciled the two profits. This reconciliation also enables us to cross-check whether we have done it correct or not. Since reconciliation is tallied, that is the marginal profit as per marginal costing, as per reconciliation is tallied with the profit as we have found out here. So it proves that we have done it correct. Okay, this is very important from examination's point of view. If there is question and there is every possibility that one sum consisting of a comparison between marginal costing and absorption costing with the numerical figures will come in the exam. There is a high possibility of that. And most often than not, these type of problems are set in the question paper. So please carefully and attentively understand these things. This is all about the application of the two systems, that is marginal costing system and absorption costing system, and also differences between the two systems. Okay, so I think this is enough for this video. I hope you have enjoyed this video. This means I mean to say that this video has benefited you. If you have any doubt in your mind, if you have any query, please feel comfortable to ask me through the comment section. I shall be glad to respond to all the relevant comments, relevant suggestions and relevant queries. Okay? Thank you very much for your precious time and watching this video. Best of luck and stay well.